Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Markify. I'm your co-host Joel Elconin, along with Dennis Dick, and we have Karl Snyder on the line. He's a chief market strategist with Garden State Securities. Karl, how you doing on this Monday morning?
I'm doing great, guys. Good morning, and how are you?
Good, good. Well, thanks for coming on. So, we've been talking to you for quite a while here, and you're a market technician. You respect the technicals in the markets, and I'd say pretty much for the majority of the time we've been speaking with you, you've had a pretty bullish stance. Is the market activity as of late shaken your belief in this bull market?
It has over the summer.
Okay.
It really has. And the reason why is because we had the canary in the coal mine with transports, but you have these divergences in the market. However, you can't act on them. It's ultimately price within the market, especially when you have a long-term uptrend like we've had. I think really what solidified the turn and the downward bias in the markets is what happened the end of August. Now, everybody can say the flash crash and et cetera on August 24th, but let's rewind a little bit just to the week before. The week before, on August 20th, we saw the Dow Industrials generate a Dow theory sell signal. So that was something I thought was very important. And also what was important is on that same day, the S&P broke down out of its range. It had been trading in the range predominantly all year from 2040 to 2130, 2135, call it. And on that same day, the 20th, we saw the SPX close down out of its range, and the following that next day too, industrials went further down, and the SPX closed that Friday at 1970, which I thought said, okay, this isn't a one-time event. When we're in this long-term range, you're looking for a breakout either way. I thought it would be to the upside, but you have to act on price, obviously. So we were waiting for price to confirm upside or downside, and now we have the downward confirmation.
And you're right. People do not put enough emphasis on that you did have the breakdown. We did have the trading range for quite a long time. We were at the lower end of the range. It's almost like the big money knew. We broke down, we took out the range on that Friday, and then we had to follow through on the Monday here. So I guess we're about 80, 90 points away from that flash crash low. It's the same from the flash crash high here. So the way you're speaking now, you think we're going to see the lower end of that range before we see the upper end?
Yeah, I was listening to you guys this morning, and you were referencing how my buddy JC Peretz, All-Star Charts, talks a lot about overhead supply, but all technicians do. We've got just so much overhead supply in the markets right now. Go back and look at the SPX. Not to get too technical, but we recently saw a shooting star. That's when price opens. You have intraday movement, where price goes higher, and then you ultimately close either down or very close to the open at the day, forming what it looks like a little shooting star. And that was back in September, when that was actually Fed Day. Okay, we went to 2020, and that's an important range too. 2020, we had a gap up earlier in the year on the SPX. So there's just so much. That's why you have to respect these technicals, and people who don't respect support, resistance, etc. I think they're doing themselves a really big disservice. So we have now a lot of overhead supply, and I'm still of the mindset with the firm at Garden State, where the thought thesis that I'm putting out is that right now all rallies, in my opinion, should be sold into. Not necessarily saying you're shorting those, especially because we do a lot of wealth management, et cetera, but if you're looking to close out positions, things of that nature, don't buy strength here for certainly.
Yeah, we've been talking
because anytime
about
strength.
that.
I'm sorry. Go ahead.
No, we've been talking about that. Even chasing the market on the upside, you can get hurt. Well, chasing it on the downside too, shorting it in the hole. Today you just short. Apple comes out that news. Apple green on the session now. You'd just be kicking yourself if you had a short overnight in Apple. SPOOs are down 11. You're thinking, oh yeah, I'm gonna make some money on this one, and now it's the only stock in the green. So yeah, I have to agree with you on that. If you were listening to the show earlier too, Karl, you were here, Dennis and I just, we look at these charts from the flash crash, and it's like we just want to take them off our platform. because so because so little stock traded there. Now, some of your thicker stocks, your Wells Fargo and whatnot, didn't kind of have that, the price aberration. Some of these other ones, I mean, do you try and just like put your hand over the chart and try and block that out, or are those valid technical points in your opinion?
I think some of them are. I think because we went low, and I think with individual names, I don't know if all of the lows that we saw, the flash crash, the lows in those names are going to be very valid on specific names. I mean, we got some really disconnects in price, and especially if you look to the ETF sector. I mean, there was just a big
Yep.
disconnect. However, if you look to the market levels, that's where I think there's not those are important levels. The actual indices. You have to look and respect that. You have to respect that 1867 on the S&P, which I personally believe we retest it, if not break it, and we look at last October's lows. But for individual stock names right now, I think yes, you can kind of put them there at certain levels, but certainly if we break 1867. I think then those levels that we saw, quote unquote, flash crash day, do come into play.
All right. So, I mean, I know you have people with, different, lots, different stages in their investing life here, right? Like if people are retiring or people are younger, are you just in general here? I mean, are you talking about going to a large cash position here, maybe over 50%, maybe 60%, 100%? When you talk about, selling rips and raising cash and stuff, and I know you have to tailor it to individual clients' portfolios if they're buying a new house, have kids going to college, retiring, whatnot. But where are you comfortable with a cash position in your portfolio?
Quite frankly, with the asset allocation that we do, not stocks and things, but for the overall people entrusting us with their wealth and wealth management, et cetera, we have a very high level of cash. We're not 100% cash, and I moved to that slowly over the summer, started more and more, and after Dow Theory cells kept generating higher and higher. But the week afterwards is basically when, looking at trends and everything, we're out of the market for the most part. We have some treasuries, but I do a lot when it comes to the wealth management, asset management side of what we do at the firm. I'm a big believer in long-term trends and avoiding the big drawdowns, because that's what really puts a lot of ruin in individual accounts, or the large drawdowns. It makes it so much harder to get back to a certain level, obviously. So we are well over 70% cash.
Whoa, 70% cash. But if you're a believer in the long-term trend, isn't the long-term trend still higher on the overall market despite this recent 10, 12% correction?
I don't believe so. I'm looking, I mean, you could draw, and that's where some subjectivity comes into it. You're looking at long-term trend lines, et cetera. I'm looking at different types of trend lines. I think that we have really the long-term trend is broken. Now, that's not saying that we can't be in a quote-unquote, so many things get thrown around: secular, cyclical, bear, bull. With the change in trend, we never know. Only hindsight will tell us if a 10, 15% drawdown will turn into a 30 to 40% drawdown. So that's why the reason we've raised a lot of cash, because a lot of the trends, the primary trend, in my opinion, and looking at the charts and so much confirmation to the downside, has changed. And it's not like we sold at the lows. We certainly didn't sell at the highs either, but we did a lot of risk management. We're kind of observing the market. We think that right now there's just too much risk for the reward that you take by being what I call being just long beta, being in the market, having that beta exposure because of all that overhead supply, like we said, and the long-term trends and such. And it's global. It's everywhere in the marketplaces. There's not any index that's really, unless somebody can pull something up obscure, that's doing well. And it's all asset classes across the board. So I'm not calling crashes or anything of that nature, but anyone who could say how far down we go, I certainly wouldn't believe them. I know there's levels, but until the trend changes, I'm comfortable holding a lot of cash right now.
And you just talk about selling rips here. You just had your Apple news, right? good news
Yes.
all around, and you get a rip in it. You were trading at 114. You just get a bounce over 115 here. You get to 115.17. Boom, you're right back down 75 cents off of that. So there's just another good example. Carl, I got to ask you about these dividend stocks here. And Dennis and I were just reviewing the top components in the S&P. And a lot of these have these juicy, 3, 4, 5, 3.5%, 3% dividend. Is this a value trap here? You think people are just, going to come in and, I'm protected. I have principal, 3, 4% downside. What's this, value trap or good deal in the market?
Again, I believe right now to buy something explicitly for its dividend is wrong. I mean, if you want to go that route, look to bonds, of course. That's my personal opinion at this juncture, because we saw what happened to utilities. Everybody chased utilities for well over a year. And because, they've got such a great dividend. Well, the dividend kept getting smaller and smaller as price goes up. And what do we have now? We have a very large pullback in the utilities. So you may say, well, my dividends increased, but it really hurts, though. I don't feel comfortable saying I've got a 4% dividend when I've just lost 15% of my capital.
What about like preferred stocks and stuff? Do you look at any of those? And some of these preferred stocks I'm looking at have 5, 6, 7% dividends even. Even if you look at the overall, the PFF, which is an ETF that tracks it, it is a 6.1% dividend. Is that something you're interested in? Because obviously the beta is very low on something like that. I mean, this stock, this ETF hardly moves.
No, you're right. Absolutely right about that. So preferred could potentially be an area to look at. If you feel necessary that you want to be in that space, I think that instead of buying individual names, you might want to be long the ETF. Again, but if you see, unfortunately, we had that quote-unquote flash crash, and we see that it just looks really crazy. You say how this never moves, and then we saw that one day where
ridiculous.
Yeah, on the chart, and people could say, well, that was just a one-day aberration. I don't know. The quirky things happened that day, so I wouldn't be overly exposed to that. And there's the reason why other risk factors come into, because you're seeing credit spreads getting wider. So it means that, what we have in the market is you're seeing obviously volatility, of course, with the VIX, but I think you have a bigger picture now too, is I think there's going to be some uncertainty and some concerns about overall liquidity in the market. And I think that may have been an issue on the day of where all these ETFs just were really mispriced.
Absolutely an issue. Carl, before we let you go, though, you got to have one stock out there that you're eyeballing. You got a long pick here of, 70% cash, so that 30% has to be in something. What do you got that 30% in, Carl? Come on. We want to know.
There are. I mean, there's a couple of names because they've just been doing well and you can stay with them. You've got your Nike, you've got your Under Armour, a couple of names like that. And you can look for the stocks that have, instead of trying to pick bottoms, go with stocks that have been performing well, and most importantly, keep your stops very tight. That's what I'm looking at right now. You got to keep stops tight. But Under Armour, Nike, few of those names where just the relative strength has been very, very strong. So continue to follow that relative strength if you're going to insist on being long the market.
Before we let you go, Carl, commodities, come on. What about commodities here? Gold down 1740. I mean, can we get you interested in gold or the oil patch? Or what about Alcoa splitting into two companies today? You must want to. I can't write enough buy orders for that today.
Well, I really sound very bearish. It's not that I'm so much bearish. I'm just really, really cautious, guys. It's because
it's okay.
The reason being is because everything is risk reward when you're managing money. So going back to your point, you can have it if you're managing. You have somebody's portfolio where you're doing asset allocation, managing that kind of wealth. Then you're leaning more towards a lot of preservation. I don't want to say there are not opportunities in the market. There certainly are. But, you want to make sure your trading positions are much smaller. That's how I'm doing with the people who want to still be in stocks, individual stock names. You want to cut your position size down. Going back to your question, commodities look horrible, just more signs of disinflation in the market. Gold, looks like it could potentially be bottoming for a potential trade. But that's all it looks like right now because everything going across asset classes, the trends are all down. And all the uptrends have rolled over. So until you can see some more positive price action, I think that you're better off, evaluating what your risk reward is and knowing exactly, defining what you're looking for when you're going into a trade. If you're looking at longer term investments, I think you still have time to just kind of wait it out. If you trade, obviously, you want to make sure that your stops are tight. You want to make sure that you're doing a really thorough risk reward analysis on everything you're doing right here.
We've been on the line with Karl Snyder. He's Chief Market Strategist with Garden State Securities. Karl, thanks a lot. I mean, that was just an honest opinion of the markets, where they are, what the charts are telling you, and I think more Wall Street professionals should be like you, and maybe we can avoid some of these crazy situations. But great input, and I'm going to make sure Brianna gets you back on the schedule soon.
Always a great time, guys. Take care.